What if I told you the world's most powerful currency could crash, not because of war, not because of a global crisis, but because of one single decision made behind closed doors? The US dollar controls global trade, oil, banks, and even your savings. And in this video, I'm going to show you how one move could shatter that system and exactly what it means for you. The Financial Codex, exposing what the world doesn't want you to know. The US dollar isn't just money, it's the heartbeat of the global economy. Every day, trillions of dollars move through international trade, oil markets, and banking systems, giving the United States unparalleled influence over global finance. Over 60% of all foreign reserves held by central banks worldwide are in US dollars, and nearly every major international transaction relies on this currency. From Tokyo to London to Dubai, the dollar dictates the rules of trade, investment, and economic stability. But here's the alarming truth. This dominance is fragile. The dollar's value isn't guaranteed. It exists because people trust it. Trust that the US government can pay its debts, maintain inflation at manageable levels, and uphold policies that keep foreign investors buying treasury bonds. The moment that trust wavers, confidence erodes, and a global financial ripple begins, one that can reach your bank account faster than most people realize. Even subtle shifts can spark alarm. Imagine a sudden policy announcement, a change in trade agreements, or unexpected geopolitical tensions. Each of these could signal instability to investors and governments, triggering rapid reactions in currency markets. Central banks might adjust their reserves, hedge funds could start selling off bonds, and international trade could slow as confidence falters. The dominoes fall quietly at first, but the result can be catastrophic. For decades, the phrase "in dollars we trust" has been more than a slogan. It has been a guarantee that fuels global commerce. But like any system built on confidence, it can be tested, strained, and broken. The US dollar's role as the world's reserve currency is maintained not by magic, but by careful policies, global agreements, and the ongoing trust of millions of investors and institutions. One wrong move, one misjudged policy, and that trust can crack, sending shockwaves across the globe. This isn't just theory. The consequences of instability reach every corner of the financial system. Stocks, bonds, commodities, and even the price of everyday goods are tied to the health of the dollar. For the average person, a decline in confidence can mean higher costs, rising inflation, and a direct hit to savings. Understanding the delicate balance that keeps the dollar strong is crucial, because when it falters, the impact is not just for bankers or politicians. It's personal, immediate, and unavoidable. While the US dollar dominates global finance, its power is surprisingly fragile. Experts warn that it wouldn't take a massive war or global catastrophe to shake it. Sometimes, all it takes is one decision made behind closed doors. This decision could come from the Federal Reserve, Congress, or even foreign governments altering their economic strategies. And when it happens, the ripple effects would be felt worldwide, almost instantly. Take interest rates as an example. The Federal Reserve controls the cost of borrowing money across the United States. A sudden, aggressive hike in interest rates could tighten liquidity, making loans more expensive for businesses and consumers alike. Companies might struggle to cover costs, mortgages could spike, and consumer spending could contract sharply. Investors, seeing instability, might begin pulling money from US assets, putting additional pressure on the dollar. Then there's the massive portfolio of US Treasury bonds held by foreign governments. China, Japan, and other nations collectively hold trillions of dollars in these bonds. If they lose confidence, even slightly, and decide to sell, the demand for the dollar would drop rapidly. This isn't just numbers on a balance sheet. It's the foundation of trust that keeps the world's largest economy functioning. A sudden sell-off could spark panic in currency markets, causing the dollar to weaken almost overnight. Even seemingly minor decisions can set off a chain reaction. A subtle policy change, a trade disagreement, or an unexpected geopolitical move can trigger financial markets before anyone has time to react. The system relies on confidence, and confidence is fragile. Once shaken, the effects are unpredictable. Banks, investors, businesses, And everyday consumers could all feel the impact. Not next year, not in theory, but immediately. History offers lessons. Countries like Argentina, Venezuela, and Zimbabwe have seen rapid currency collapses when confidence eroded. While the U.S. economy is far larger and more complex, the principle remains: trust is everything. One miscalculated decision, one overlooked risk, and even the world's most powerful currency could start losing value. For the average person, the consequences would not be abstract. Rising costs of goods, sudden inflation spikes, and even impacts on savings and investments could occur. The reality is chilling. In the interconnected global economy, one decision at the top can send shockwaves straight to your wallet. Even the strongest currencies give warning signs before they falter. And the US dollar is no exception. While headlines often celebrate stability, the financial elite and global markets quietly watch subtle shifts that reveal cracks in the dollar's dominance. Recognizing these signals early could mean the difference between being prepared or being blindsided. One major indicator is foreign holdings of U.S. Treasury bonds. Countries like China and Japan hold trillions of dollars in these assets. In recent years, both have slightly reduced their positions or diversified into alternatives like gold and foreign currencies. While these moves may seem small on the surface, the sheer scale of global reserves means that even minor reductions can weaken confidence in the dollar. Another glaring sign is the surge in gold purchases. Historically, gold serves as a safe haven when fiat currencies are under threat. Central banks across the world have been quietly stockpiling gold at record rates, a clear signal that confidence in the dollar may be shifting. When institutions that normally rely on the dollar start accumulating gold, it's not a casual choice, it's a strategic hedge against potential instability. The rise of alternative currencies is also telling. More nations are exploring trade agreements and financial instruments outside the dollar system, often using the Chinese yuan or digital currencies. Even small increases in non-dollar trade can gradually erode the dollar's global dominance, creating pressure that can accelerate if a crisis hits. Domestically, subtle economic indicators matter too. Rising inflation, growing deficits, or unexpected policy changes can signal underlying weakness. If interest rates are altered too aggressively, or the national debt continues to swell without control, investor confidence can waver. Markets are highly sensitive, and the first signs of hesitation can trigger rapid reactions, affecting stock prices, bond yields, and commodity costs. The danger is that these signals are often invisible to the average person until the impact is already underway. Banks, multinational companies, and governments monitor every shift closely, but ordinary citizens rarely notice the warning signs. Understanding these indicators is essential. When the dollar shows cracks, it's not just a number on a screen, it's a real threat to your savings, investments, and the cost of everyday life. The takeaway is clear. The dollar may appear unshakable, but subtle movements today could determine whether a financial storm hits tomorrow. Recognizing these signs early is the first step in protecting yourself before it's too late. If the US dollar were to suddenly weaken or collapse, the effects would ripple across the globe almost instantly. The dollar is not just a currency, it is the foundation of international trade, banking, and financial stability. A sudden loss of confidence would trigger chaos in markets, impact everyday life, and potentially reshape global economic power. The first and most immediate impact would be on global stock markets. Investors worldwide hold assets denominated in dollars, from stocks and bonds to commodities. A rapid drop in the dollar's value would spark panic selling. Retirement accounts, pensions, and major institutional investments could lose significant value almost overnight. The financial shock wouldn't be isolated to the United States. It would spread to Europe, Asia, and emerging markets, creating a domino effect that few are prepared to manage. Inflation would also surge. Many essential imports, including oil, machinery, and food, are priced in dollars. As the currency weakens, the cost of these goods would skyrocket globally. Consumers in every corner of the world would feel the impact in grocery stores, gas stations, and household bills. Countries heavily reliant on the dollar for trade would face severe economic strain. potentially sparking recessions or slowdowns in multiple regions. Banks and financial institutions would face unprecedented stress. Credit markets could freeze as confidence in dollar-denominated assets declines. Companies dependent on loans could struggle to maintain operations, leading to defaults and bankruptcies. Even large multinational corporations, with billions in reserves, would feel the pressure if the system that underpins international finance begins to crumble. Trade would be disrupted. Nations using the dollar for contracts would scramble to find alternatives, delaying shipments and destabilizing supply chains. Emerging economies could suffer the most, as their reliance on U.S. financial systems is disproportionately high for individuals. The effects would be immediate and personal. Inflation, higher interest rates, and rising costs for basic goods would hit ordinary households first. Retirement savings and investments could lose value, and even daily financial decisions would become more complex. The reality is clear. The strength of the U.S. dollar underpins the world economy. A collapse isn't just an abstract scenario. It is a high-stakes possibility that could alter the lives of billions. Recognizing the fragility and preparing for potential outcomes is no longer optional. It's essential. While the thought of the U.S. dollar weakening or collapsing is alarming, there are practical steps individuals can take to protect themselves. The key is preparation, diversification, and understanding warning signs before the storm hits. Knowledge isn't fear, it's your best defense. The first step is diversification. Don't rely solely on cash or dollar-denominated assets. Consider allocating a portion of your wealth into gold, which has historically retained value during crises, or other tangible assets like real estate and commodities. Stocks of multinational companies, which earn revenue in multiple currencies, can also act as a buffer. Even small investments in alternative currencies or digital assets can provide an additional hedge against sudden dollar weakness. Next, stay informed. Monitor key economic indicators such as interest rates, inflation trends, and major policy announcements from the Federal Reserve and Treasury. Keep an eye on international moves, like foreign governments adjusting their reserves or central banks buying gold. These are early warning signs that the global financial system may be shifting. Being aware gives you time to make strategic adjustments before it's too late. Debt management is equally important. High-interest loans or large mortgages can become dangerous if liquidity tightens or inflation spikes. Reducing unnecessary debt and maintaining an emergency cash reserve ensures flexibility. During turbulent times, even a small financial buffer can make a huge difference if markets suddenly turn. Another crucial step is thinking long-term. Protecting your wealth is about strategy, not panic. Diversification, knowledge, and patience work together. Those who prepare before a crisis are far more likely to navigate the storm successfully than those reacting at the last minute. Finally, consider alternative financial strategies. Some individuals explore accounts in stable foreign currencies or diversify their investments across multiple countries. This isn't just for billionaires. Even small allocations can reduce personal risk if the dollar suddenly loses value. The takeaway is clear. One decision at the top could shake the U.S. dollar, but your preparation can shield you from the worst effects. The global economy may be fragile, but with awareness, diversification, and careful planning, you can protect your savings, investments, and financial future. In a world where one move can change everything, knowledge and action are your greatest assets. Did you enjoy this video? Then make sure to subscribe to our channel, and in the next video, we'll bring you even more shocking financial truths.